Hello and welcome to another edition of Econoday Unplugged. It's Tuesday, the 23rd of April, 2024. I'm Jeremy Hawkins in London, and in today's podcast, we'll be focusing on the recent March shift in sentiment regarding Fed policy. And to do just that, joining me is Terry Sheehan, Econoday's US expert. Okay, Terry, only a few weeks ago, financial markets were all but convinced that the Fed would lower its funds rate target in June. However, as we record today's podcast, futures markets are currently pricing the probability of a 25 basis point ease then at only around 16%. Most investors seem to have switched back to the higher for longer view, and some are even questioning whether interest rates will be cut at all in 2024. So, what's prompted the change?
Well, at the March meeting, the Federal Reserve policymakers issued their forecast, which said they were anticipating 3 rate cuts of about 25 basis points each in 2024. And then in the next few weeks, we got a barrage of economic data that basically said progress on inflation had stalled. The labor market remained quite strong. The US economy is growing consistently and modestly. And the circumstances are such that policymakers are neither want the economy to overheat by reducing rates and stimulating it more, and they don't want to reduce restriction on monetary policy because they're still concerned about inflation. So basically, prospects of a rate cut this year have been greatly diminished.
Okay, I'll ask you this, I think, on the last podcast you joined us. Earlier today, Hugh Pill, the Bank of England's chief economist, said that the greater risks lie with easing policy too early than too late. Is that true of the Fed as well?
Yes, it is. And in fact, Jerome Powell has been explicitly saying that in his recent remarks.
Right. So let's go on then to, so some of these underlying factors which have changed the market view. And I guess we've got to go back to the March CPI, which was obviously higher than expected, both the headline and I think the core, if I remember rightly, as well. And certainly we saw, I think it was the biggest jump in 10-year Treasury yields in about a daily jump in about a year and a half or so. So what's your kind of sense about where inflation is at the moment? I mean, do you think, given we know we all get a lot of volatility in the monthly data, the March number was perhaps a bit of an aberration and markets have read too much into it? Or is it something you think that the Fed should actually be perhaps a little bit more concerned about than they were if we go back to March time?
Well, I think that Fed policymakers have expressed that concern by their messaging in that, they're expecting rates cuts to be later than originally thought. And looking at some of the April surveys of manufacturing and service sector, we're seeing that their prices paid indexes are somewhat higher than they were in March. So, it may be that the stall in the inflation improvement is going to be a little more sustained than could be hoped.
Okay, let me ask you just perhaps some nitty-gritty on some of these inflation numbers. It seems now that, as everyone tries to work out what's actually happening with underlying inflation, there's a whole range of different indices that the folks are looking at. Can I ask you about, seems to be quite a lot now attention on this so-called super core inflation, so service sector inflation excluding food and energy. Now, and I was just looking at the numbers a short while ago, it seemed that, looking at some of the annualized rates now, this thing really is moving up quite sharply. I think the last figure I saw was something like 8% over the last 3 months annualized, and even the year-on-year rate is up at 4.8%. Is this kind of some of the key components that the Fed really is looking at, or is there something else? I guess there's a variety of different indicators, but what do you think they're actually concentrating upon when they're setting policy?
Well, of course, their preferred measure is the PCE deflator, which is released with personal income data. But they are certainly looking at a range of indicators. The next most important clearly would be the CPI. Several of the Federal Reserve district banks have their own version of the CPI. They have some sort of trimmed mean ways of trying to get rid of the extreme outliers to something that's more of an underlying rate. It's hard to say what the very best measure is right now. I mean, we can consistently see that service prices are experiencing continued upward price pressures. Commodities prices have moderated significantly. So it's just a question of, are these services prices at a consumer level, or are they at a business level? Where are these price pressures coming in? And it's really hard to get to that through some of these aggregated measures.
Right, fair enough. I guess in terms of, you mentioned that it's the price deflator for consumers' expenditure that the Fed's actually tries to target. We'll get that, of course, updated, I remember rightly, on Friday. If we were to get, let's say, a bad number there, I'm looking at Econoday's consensus. I see we have, well, certainly for the core index, which I guess is the most important, we have 0.3 on the month, 2.7% year on year, which would be down a tick from last time round. Let's suppose that came in at 3%. What do you think that would mean for Fed policy then?
Well, I think it would ease some of the concerns about the length of time before we see a rate cut. Fed policymakers are looking for consistent, steady drops. A big 1 month movement is not going to really change their thinking much. But seeing these incremental 1 2/10 declines consistently over time is something that is encouraging to them.
Okay, which also suggests don't hold your breath in terms of expecting a near-term cut, presumably. Now, I guess quickly just on that, I should mention, I mean, the focus, I think, in financial markets has been very much the June FOMC meeting. Of course, next week we get the May version. Is that something which you think is basically no interest whatsoever, or should folks be looking at that to try and glean some kind of idea of what they might do come the next one actually in June?
Well, I think as far as interest rate policy goes, they'll reiterate that they are data dependent and they're making their decisions on a meeting by meeting basis. I think they may tweak the language just a little bit to help people understand that rate cuts will come eventually. I mean, Powell has said that they think that rates are at their peak, and that really hasn't changed in their thinking. So it's just a question of trying to get the right balance between the strength in the labor market and the upward price pressures for price stability. And so I don't think we're going to see a lot of change in the statement that comes out on May 1st. The one thing I think will happen with the May 1st state meeting is that we will get some more information on their plans to slow down the their program to reduce the size of the balance sheet and their reserve bank holdings.
Oh, interesting. Okay, that's certainly something to look out for. But also picking up something you said, I mean, so far I've just talked about inflation. What about the rest of the economy? I mean, I think last time when we were chatting, the numbers were coming in above expectations, typically speaking anyway. And we've had now, some really strong payroll numbers. I mean, just looking at the quarterly growth in payrolls, it seems to be hardly consistent with the idea that the economy is anywhere near a recession. So, I mean, what else should we be looking at? I mean, presume it's still the employment report, non-farm payrolls, wages, etc. The Fed looks at when it's trying to make an idea about where inflation's going. What else is going to be driving Fed policy at this stage?
Well, I think what they're going to be watching closely is consumer spending, because that's really been the driver of what's going on with the continued modest to moderate growth in the U.S. economy. And as long as wages continue to rise steadily, the pace of wage growth has slowed down considerably, but it's still something over 4% on a year-over-year basis. if consumers continue to see income gains, there's relatively little reason to think we're anywhere near a recession.
Well, I guess that's kind of what I'm coming down almost like the key question now. I mentioned in the intro that there are certainly some people now thinking that perhaps the Fed, won't cut interest rates at all this year, simply because we've been through so the inflation numbers have been a little bit disappointing, and certainly they're still too high. And by and large, the real economy has been outperforming expectations. In fact, if we look at Econoday's relative performance index, which tries to pull together how forecasters have performed in terms of calling the actual data, that's been above zero, which means forecasters have been too weak in their projections in 4 of the last 5 weeks, which is again consistent with this idea that the US economy has been doing better than expected. If we pull that little lot together, we'll get the GDP numbers, I think, out for the first quarter, don't we, this week, which I guess are expected to be quite respectable. So, at the end of the day, should the Fed even be thinking about cutting interest rates in the first place?
Based on how they approach monetary policy, probably not. There is, as long as growth is where it is now, I realize that there are certain sectors of the economy, like the interest rate sensitive ones, housing particularly, that are not doing as well as they might. But overall, the US economy is turning in a solid performance. So why should the Fed change rates?
Interesting, this, isn't it? So if you put your head on the chopping board, then when do you think the Fed will move?
No earlier than September at this point, but I think we might see one in December.
Okay, fair enough. And one last question from me before I ask you anything else you'd like to say. Do you think it's actually possible, as a few people now are starting to intimate, that the next move by the Fed might be to raise interest rates rather than to cut them?
The Fed will never say that it is completely writing off the possibility of a rate hike based on what the economic data is. However, Chair Powell has signaled that they think the rates are at their peak and they aren't going higher. But that's a forecast, not a promise. So unless there is a surge in economic activity that is not expected, or a surge in inflation, I don't think rates are going to go any higher.
Okay, fair enough. Anything else you would like to add before we wind things up?
No, I think we've covered it all.
Okay, in which case, Terry, thank you very much indeed for all that. Well, I guess it seems then with the ECB on course to ease in June, both the Bank of England and the Swiss National Bank potential candidates to cut before the Fed as well. Interest rate differentials are poised to move in favour of the dollar, all of which, if nothing else, should certainly make for an interesting time in the FX markets to come. In any event, don't forget that you can always keep up to date with all the key central bank moves and, of course, the data that determine them in Econoday's global economic calendar. So that's it for Terry and me for today, but we'll be back with another podcast soon. So thanks for listening and bye for now.